Yes, it is possible to pay zero taxes with over $120,000 in income. First, and understandably, there's a great deal of confusion on how our tax code works. And one of the most common areas of confusion comes from the fact that we actually have two separate income brackets. We have our ordinary income tax rates, which is the 7 bracket rates that most people are already familiar with. And then we have the more favorable rates for qualified dividends and long-term capital gains, which have 3 brackets of rates. And in this favorable 3 bracket part of the tax code, there is actually a 0% tax rate, and then a 15% tax bracket, and then a 20% tax bracket, and they're all pretty large. And this provision, which has been in effect since 2008, allows individuals or those married filing jointly to pay no taxes on their capital gains and qualified dividend income from their taxable investment accounts. Despite its existence for over a decade, many taxpayers are unaware of this opportunity, or they simply don't understand how it works, again, because of the complexities of our U.S. tax code. Now, on to the how. Well, to qualify for the 0% tax rate in 2024, single filers would need to have income below $47,025, and couples married filing jointly need to have income below $94,050. And also, there's going to be further adjustments to taxable income from stuff like the standard deduction, and this can expand the portion of income subject to this rate. So for instance, single filers with a standard deduction of up to $14,600 could potentially have up to $61,625 of capital gains and dividends taxed at the 0% rate, while couples who are married filing jointly with a standard deduction of $29,200 could have up to $123,250 in the 0% capital gains bracket. So that is over $120,000 of income with no taxes owed to the IRS. Not bad. When can we use this? Well, the 0% rate bracket can be most beneficial for those experiencing lower taxable income periods. For instance, maybe you're between jobs and we're going to have a lower income one year, or maybe you've retired and you have not yet begun to take Social Security, pensions, or started to withdraw money from your IRAs or tax-deferred accounts, or of course anything that would cause ordinary income. And this is because there is a stacking rule that requires eligible income to be added on to the top of other income, potentially reducing the benefit for higher income individuals. So, careful planning is obviously going to be necessary to take full advantage of this kind of opportunity. Now, maybe you've heard of tax loss harvesting. Well, this is actually tax gain harvesting, where we are filling up a 0% bracket by selling an investment with long-term capital gains, by buying back the same investment if we want to, in order to lock in those gains in the 0% tax bracket. And why do we want to do this? To lower lifetime tax liabilities, because that tax is owed at some point, right? Because of course, when do we want to pay taxes? We want to pay them when they are the cheapest or lowest. Let me give you an example of how this might work. Let's say a married couple just retired and they've owned Caterpillar stock for a very long time and they want to keep owning it, but they're sitting on about $400,000 of long-term capital gains. Now, let's say they aren't going to have any income in 2024 because they recently retired, and they won't have any earned income, and they haven't flipped on Social Security or pensions, and they have over a decade before they have to start taking the required minimum distributions from their tax-deferred accounts. So they also have a decent chunk of cash in the bank account so they can just use that for living expenses this first year. So we're going to sell enough Caterpillar stock to lock in $123,250 in long-term capital gains. And then we're going to just buy that stock back the next day. So now they still own Caterpillar stock, but they just locked in a 0% tax rate on $123,250 in long-term capital gains. So again, that is over $120,000 in income with no taxes owed to the IRS. Let me cover a more common scenario. So let's say that you're a retired married couple filing jointly and that you're both age 64. And let's say that you have that same $400,000 in gains in Caterpillar stock. But you're both receiving your Social Security benefit already. If you only have Social Security on your tax return, then you're not going to have to pay any federal income taxes at all. But if you're going to need future income from your taxable account, and if you are sitting on a large unrealized gain, like the $400,000 gain in Caterpillar stock, it might be advantageous to go ahead and realize some of those investment gains, which, yes, are going to cause your Social Security to become taxed because of the Social Security provisional income formula and its associated thresholds, but it would be in the historically low 10 and 12% ordinary income tax bracket. And then you could still lock in investment gains in the 0% capital gains brackets. For instance, let's say that together you have $40,000 in taxable Social Security income and you have the standard deduction of $29,200. Now recall from the previous example, you can max this strategy with $123,250 in the zero gains bracket. But now you have to subtract the $40,000 in taxable Social Security income. So you take $40,000 from that $123,250, and that still gives you $83,250 that you could show in realized investment gains in the 0% tax bracket by selling the Caterpillar stock. And again, this is because of the qualified dividends and capital gains brackets stacking on top of ordinary income tax rates. Clear as mud, right? Now, sometimes when I mention this strategy, people say, hey, Tim, what about the wash rule? How does that work? Well, the wash rule states that if an investment is sold at a loss and then repurchased within 30 days of the initial loss, it cannot be claimed for tax purposes. The key word here was loss. With tax gain harvesting, we're selling with a gain. So the wash rule doesn't apply. Bottom line, many factors are going to play into if and when you should use the strategy. Of course, factors like the size of your taxable and tax-deferred retirement accounts, any expected payouts that you're going to need in the future, any expenses, any federal and state income taxes, of course, are going to play a key role in making this decision. But it's a great strategy if you have eligible gains or dividends, especially if you have a greatly appreciated asset that you're sitting on. A key point to remember is that capital gains stack on top of ordinary income. So for this strategy to work, ordinary income must be relatively low. However, potentially paying 0% on capital gains of up to and over $120,000 in income can have a significant impact on your overall financial well-being by limiting your lifetime tax liabilities. And as I like to say, we always want to pay every cent that we owe to the IRS, but we never ever want to leave them a tip. So thanks for tuning in. Talk soon. Once again, Tim Dorman here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives and retirement, please visit us at erwealth.com, and we hope to see you there.